Let's talk about a company that's pretty much the backbone of the global economy, moving all the raw materials that, build our cities and power our world. That company is Starbulk, or SBLK, and it's one of the biggest dry bulk shipping companies out there. In an industry that's known for its absolutely wild swings, Starbulk has a really fascinating story. You see, the shipping industry is famous for being cyclical. We're talking massive booms followed by some truly gut-wrenching busts. So, the big question we're digging into today is this. In a market that's so turbulent, how does a giant like Starbulk manage to not only survive, but actually thrive? That's really the core of what we're looking at. Now, we're going to do things a little differently today and actually start with the conclusion. So, what's the bottom line on Starbulk? Where do the experts land on this company right now based on all the data we have? Well, experts kind of see Starbulk as two things at once. On one hand, it's a value growth stock, which is perfect for traders who like to ride the industry's ups and downs. But on the other hand, it's a high dividend payer, which really appeals to those long-term investors who are focused on generating income. It's this unique combo that puts it on a lot of different watch lists. Okay, so that's the verdict. But talk is cheap, right? We need to see if it's justified. To figure that out, we've got to pop the hood and take a look at the company's engine, its financials. So let's dig into the numbers. First up, earnings. This number right here, 28 cents, that's the adjusted earnings per share for 2025. And the really crucial part? This number easily beat what analysts were expecting. In a tough market, outperforming expectations like this is a really powerful signal that they know what they're doing. Next, let's talk debt. Now, for a company that owns these massive, incredibly expensive ships, a net debt of around $610 million is, well, it's remarkably healthy. This shows they've been super disciplined, paying down a lot of debt and making their balance sheet stronger, which gives them a ton of flexibility. And all of that brings us back to that high dividend payer label. Because they have such a strong balance sheet, they can do this, consistently give cash back to their investors. And this isn't some random bonus, okay? It's a core part of their strategy, and it's management's way of signaling their confidence in the company's future. Every great company has an edge, something that protects it from the competition. For Starbulk, it really comes down to a key piece of technology that you could almost call its secret weapon. Let's check it out. That weapon is the scrubber. Now, it sounds super technical, but the idea is actually pretty simple. It's a system that cleans a ship's exhaust. And what that does is it allows Starbulk's ships to burn a cheaper, less refined type of fuel, all while still complying with very strict environmental rules. It's a total game changer. And here's why it matters so much. Because Starbulk went ahead and installed scrubbers on so many of its ships, they get to use that cheaper, high-sulfur fuel. Their competitors, the ones who didn't make that investment, they're stuck buying the more expensive, low-sulfur stuff. This creates a direct, real, and lasting cost advantage for Starbulk on every single trip they take. But hey, it's not all smooth sailing. Of course not. Every company, especially in an industry like shipping, faces huge risks that are totally out of its control. So, for a balanced picture, we have to look at the potential storms that might be gathering on the horizon. And there are two big ones to watch. First up, China. A massive part of Starbulk's business is shipping iron ore for China's huge construction and infrastructure projects. So if China's real estate sector keeps struggling and construction slows down, well, demand for their ships could fall off a cliff. The second risk is oil prices. While those scrubbers give them an edge, wild swings in oil prices can actually shrink or even completely wipe out that advantage, which would really hurt their profits. So, with all that on the table, the good and the bad, what should you actually keep an eye on to form your own opinion? Don't worry, we're going to give you 3 very specific things you can track yourself. All right, first is the Baltic Dry Index, or BDI. Think of this as the pulse of the shipping market. It tracks the cost to ship raw materials. You'll want to specifically watch the Capesize Index. That's for the biggest ships SBLK uses. If it stays above that 1851 point level, that's a really good sign for their profitability. Second, keep an eye on their quarterly dividend announcements. A strong, steady dividend is a direct signal from management that they feel good about the future. And finally, watch China's import data for iron ore and coal. I mean, this is the lifeblood of their business. It tells you in real time what the demand for their fleet actually looks like. So, to wrap this all up, Starbulk clearly has a strong ship, right? A healthy balance sheet, a modern fleet, and it's got a smart compass. That scrubber strategy gives it a real edge. But the ultimate question, the one everything hinges on, is this. Can that combination be enough to navigate the potential economic storm that seems to be brewing in its most important market, China? That's really the key question to think about as you watch this company going forward.